In a sweeping regulatory shift, the Federal Reserve, Office of the Comptroller of the Currency, OCC, and Federal Deposit Insurance Corporation, FDIC, have repealed their 2023 climate risk guidance, ending requirements for banks to incorporate climate-related risks into stress testing and financial reporting. Regulators said existing safety and soundness standards already cover all material risks, including environmental events, making separate climate policies unnecessary. The move marks a major policy reversal from recent years, when U.S. regulators pushed banks to assess exposure to climate-linked disasters like floods, wildfires, and hurricanes. Under the new approach, banks will no longer be required to maintain dedicated climate risk frameworks, reflecting what officials call a refocus on core financial oversight. Fed Vice Chair for Supervision Michelle Bowman praised the rollback, arguing it eliminates confusion and compliance costs, saying the Fed's mission does not extend to climate policymaking. But former Vice Chair Michael Barr, who helped craft the prior rules, called the repeal short-sighted, warning it leaves the system more vulnerable to climate-related shocks. For banks, the repeal reduces short-term regulatory burdens and restores flexibility in how they account for environmental risks. However, analysts note it could create long-term uncertainty as global regulators, especially in Europe, continue to emphasize climate-related financial disclosure. The decision also reflects a broader policy realignment under the Trump administration, which has scaled back climate oversight across federal agencies, including the SEC's paused climate disclosure rule. Supporters say markets, not regulators, should determine how to price environmental risks, while critics warn that ignoring them could expose U.S. banks to unforeseen losses.